In 2008, the United States was hit with a devastating financial crisis that had a ripple effect on the global economy. The crisis was caused by a number of factors, including risky lending practices by banks, a housing market bubble, and a lack of oversight by government regulators. At the heart of the crisis were the banks themselves. In the years leading up to 2008, banks had been engaging in increasingly risky lending practices. One of the most significant of these practices was subprime lending, in which banks would offer loans to people with poor credit histories or low incomes. These loans were often packaged together and sold as securities to investors, with the banks earning large profits in the process. As the number of subprime loans increased, the quality of the loans began to deteriorate. Many borrowers were unable to make their mortgage payments, and defaults began to soar. This had a ripple effect throughout the banking industry, as banks that had invested heavily in subprime loans found themselves facing significant losses. Compounding the problem was the fact that many of these loans had been packaged together into complex financial instruments, such as collateralized debt obligations, CDOs. These instruments were often difficult to value and trade, making it hard for investors to understand the risks involved. When the subprime loans began to default, many of these CDOs became virtually worthless, further exacerbating the crisis. The housing market also played a significant role in the crisis. In the years leading up to 2008, the housing market had been booming, with home prices soaring to record levels. Many people took advantage of this by taking out large mortgages on homes they couldn't afford, assuming that they would be able to sell the homes for a profit later on. However, as the subprime loans began to default, the housing market began to collapse. Home prices plummeted, leaving many homeowners with mortgages that were worth more than their homes. This led to a wave of foreclosures, further depressing the housing market and exacerbating the crisis. Throughout all of this, government regulators largely failed to intervene. The Securities and Exchange Commission, SEC, which is responsible for overseeing the financial industry, was slow to recognize the risks posed by subprime lending and CDOs. The Federal Reserve, which is responsible for managing the country's monetary policy, also failed to take action to prevent the crisis. As the crisis deepened, the government was forced to step in to prevent a complete collapse of the financial system. In September 2008, the government seized control of mortgage giants Fannie Mae and Freddie Mac, which had been on the brink of failure. The following month, the government bailed out investment bank Lehman Brothers, which had also been on the verge of collapse. The government also implemented a number of other measures to try to stabilize the financial system. The Federal Reserve lowered interest rates to near zero, making it easier for banks to borrow money. The government created the Troubled Asset Relief Program, TARP, which provided hundreds of billions of dollars in bailout funds to banks and other financial institutions. Despite these measures, the crisis had a profound impact on the economy. Millions of people lost their homes and jobs, and the stock market plunged to its lowest levels in decades. The crisis also had a global impact, with countries around the world feeling the effects of the collapse of the U.S. financial system. In the years since the crisis, there have been numerous efforts to prevent a repeat of the events of 2008. The Dodd-Frank Wall Street Reform and Consumer Protection Act, which was passed in 2010, implemented a number of new regulations aimed at preventing risky lending practices and improving oversight of the financial industry. The Federal Reserve has also implemented a number of new policies aimed at preventing a repeat of the crisis. It's important to understand the impact of this crisis on our economy and the steps we can take to prevent it from happening again. As we've discussed, the banking crisis of 2008 was triggered by a combination of factors, including risky lending practices, the housing bubble, and the lack of oversight by regulatory agencies. The aftermath of this crisis was devastating for many individuals and families, resulting in job losses, foreclosures, and financial hardship. While we can't change the past, we can learn from it and take action to prevent similar crises in the future. That's why it's important for individuals, businesses, and governments to prioritize responsible lending practices, proper regulation and oversight, and transparency in financial transactions. We hope this video has helped you understand the U.S. banking crisis of 2008 and its impact on our economy. By working together, we can build a stronger, more resilient financial system for the future. Thank you for watching our video on the U.S. banking crisis of 2008. Please consider subscribing to our channel for more informative content.